Hey guys, good afternoon, everybody. Today is Monday, June 27th. It is 2 p.m. right now, Pacific time, time for our scheduled group mentoring session. So I'm going to go ahead and set up this room real quick, and then we will get started with our session for today. So it looks good right there. A couple more things here to update. A few more things right here, and then I will send this link out to you guys shortly. It's good. All right, looks good. Let me get this link sent out to you guys here in the premium. There we go. All right, so I'll get a few minutes for people to make their way in. As people join, I'm going to go ahead and mark up liquidity here, just in case I would like to take some trades during Asia. I don't think I'm going to be taking any trades during Asia, though. Volatility's died down pretty heavily, so it's going to mark the liquidity here. Clean it up a little bit. So liquidity there. There's a lot of liquidity that's building up on the bottom side. So possibly a drop back down by tomorrow. That's good. 15-minute. $10-minute. There, 5-minute. And the 1-minute. All right, so I think that might be about it. And I think that's it for now. All right, cool. So, all right, guys, good afternoon. It is Monday, June 27th, 2:04 p.m. We were scheduled to start at 2, so I'll give it a few minutes for people to make their way in. However, if you guys have questions ready, you guys can put your questions in the chat, and we can cover whatever you guys would like me to cover for today. One topic that we will be covering would be the liquidity zones or liquidity areas, whatever you guys want to call it. It means the same thing. We'll be covering that stuff just as a refresher so that you guys can be in tune with how to identify liquidity and why you want to identify it. So I've marked up liquidity here just in case I do want to trade during Asia session. I don't think I'll be trading though, because you guys can see right here that volatility it's a lot slower than it has been the past couple months. As you guys know, we are entering the summer session, so the summer season is typically kind of slow. For you guys that are not familiar with, why the market gets slower, it's because a lot of the bigger traders, institutions, market makers, etc., they typically go on vacation during the summer. So when they go on vacation during the summer, there's less liquidity in the market. There's still liquidity, but it's not going to be as crazy as it is during, spring and winter season. So not a big deal because we're still going to be scalping. And as you guys can see, the market still moves at least 100 pips here and there. So even if the market volatility dies down pretty heavily, it's not really going to affect us because we can still catch trades and take entries where we see fit. So yeah, so Patrick's asking, that must obviously bring less manipulation then. It's a yes and a no. So it brings less manipulation because we're not really getting much from the market makers as a whole. Typically, there's still going to be some market makers that are active in the market, some institutions, depending on the news events. So like for NFP week, we're probably still going to have some manipulation because while they're going to be on vacation, they're probably still going to be trading during the busy weeks. Typically at NFP week and then maybe Fed week. So maybe 2 weeks out of the month, it'll be a bit busier than the other days or the other weeks. And in some instances, you'll kind of get some manipulation from retail traders because the funny thing is, like, most retail traders don't really know what they're doing. So a lot of retail traders will just follow signals or they'll follow, groups. Like a lot of people trade in groups like we do, but other groups trade in higher volume, right? So you're going to see a lot of weird movements because you'll see a lot of different groups trade in one direction and they'll push price like not how market makers would push it. They'll still push in one direction, but then it'll just go flat once they run out of buying power, right? And then from that point, a different group might do the opposite, or they might continue it. So you're still going to see manipulation, but it's going to be more of like a slower push. Like you're not going to have those types of movements where you're in a position and then it's like flat, and then all of a sudden spikes up like 1,000 pips and then spikes down, right? That's like a whale move, like a whale or market maker or something like that. You're probably going to see like a quick move, like maybe half of that or less, and then it'll just probably go flat again. And then you'll see like little gaps like that. But it should be fine because if your stop loss is wide enough, you'll be able to survive whatever type of manipulation happens. And then when it corrects back into your position, you'll be fine. It's just not going to be something crazy like 1,000 pip moves or 2,000 pip moves like we've seen like today over here, right? These are like huge moves. 1,000 pip moves. You'll probably see something half of that, like maybe 500 pips, something like that. Kind of like in this type of vicinity range. So that's probably what we're going to expect. That's why right now I'm bringing back the one-on-one mentoring sessions because this is a good time for you guys to really understand the strategies and lock it down so that when the market does pick back up in the fall, you guys will be ready to pretty much lock in a lot of moves from there. But you guys can see that a lot of the liquidity zones are becoming a lot more easier to identify. So previously, you guys have seen how the liquidity zones are all spread out. You can see right here that they provide perfect entries. So like right here, this is a perfect liquidity zone. This is a perfect liquidity zone. This is a perfect liquidity zone, right? So if you see price push up to these points, you have a pretty good idea that when this gets hit, it's going to pass right through it, right? It's not all kind of messy like before. Before we'd have like 2 areas of liquidity and then it would just be a huge gap. Right here, there's like a lot of different areas where you can kind of connect the dots. So you're like, okay, price hits this point, probably push up to this point. If it hits this point, it'll probably push up to this point, right? Same with the bottom way. So down here, same situation, price hits this area. This is kind of a big gap, but it might push to some extent down there, come back for the retest, and then continue to push down lower. So it's really a good time for good practice because the market isn't moving as crazy and you guys can possibly make mistakes and still pull out at break even. Like say, for example, you guys enter a trade and you mistakenly enter a trade because you think there was an entry there. When price does pull back to your entry point and you don't feel confident about it, you can always pull out. So definitely something to keep in mind. Let's see, question from Emelzon. Emelzon's asking how long is summer season? Um, pretty much till September, or I'll say mid-September. So yeah, question from Milzon. He's asking how long is summer session? It's pretty much till like mid-September. It's just like how normal seasons work, right? It's like the school season. Like when kids go on vacation for the summer, they come back like around um, mid-September. That's usually where people come back to work. They're done with their vacations. Kids are back at school. It doesn't. It's the same thing. It's gonna be like a slow swing back into full session, but then in October, that's usually where it fully picks back up. And then it'll be busy from like October till November. Then we have the holidays. It'll slow down a little bit, pick back up mid-January, and then from January until June, same thing that we just had this year. So you guys have seen, if you guys have been following the market, or if you guys ever want to go back and just look at it, you can go back to like the 1 hour, or actually you can go to like the daily. So if you go on the daily chart here, you can kind of see how volatility picks up. Let me just clean this up a little bit. So looking at like the market from last year, let me just show you guys the seasons. The past couple of years have been a little different because we were going through COVID and whatnot. So like people weren't really going on vacation, but you guys can see from here. So let me just show you guys how the market moves. So like here is the summer season, right? I'll mark up summer season over here. Basically like mid-June until September. Right, so you guys can see mid-June till, I guess, mid-September. You guys can see how slow it moved right here, right? And then it slowly eased its way back in right here. So like basically from this point, mid-September up until, the end of the holidays right here, or until like January. You guys can see that between this point right here from June, July, August, September, about 4 months, there was barely any, there was movement, but it wasn't like a crazy amount of movement. Right here from September up until January, you can see that it pretty much had the same movement, but it was more volatile. So like right here, you see a lot of consolidation, pushes up, consolidation, push up, consolidation. Right here is like a lot of push to the upside, big push to the downside, big push to the upside, and continuation up until the end of the year. Typically from October until basically November. Well, October right here, you can see it starts late October up until December, until the end of the year. It's a big bullish push. This typically happens towards the end of the year, and then it starts to shift off from there. Again, right here, market gets kind of slow, picks back up around here, springtime, February. So as I mentioned, market kind of dies down from the holidays, late November up until mid-January. And then right here, mid-January, or you can consider this February, up until summer, this is where like the big moves happen. So February 1st up until January 25th, and you guys can measure the price here too. So the movement here during summer was about 40,000 pips, etc. Right here, it's a bit more, 5,000 pips, and then from the new year up until summer, it's about the same, but a little more. So you can see the big difference here. It's off by like maybe 10, 20,000 pips. Summer is a little bit slower, picks up right here, fall, and then spring until summer, it's a way bigger push. You can see the big increments right there. Basically 4,600 points. It goes up about 1,000 points right here, and then another couple hundred points right here. So you guys can see the difference. And you can do that as far back as you want. You can go back to like different years here, but I would be careful with the 2020 year because this was COVID. So that's why you see this big crazy push right here. This doesn't typically happen. It's just because COVID happened. And then same situation over here with 2021. So if you guys want to play around with it, feel free. The more that you guys play around with it, the more that you guys will like really understand it, because I can explain this like in as many ways as possible, but realistically, you're not going to get it until you actually play around with it. You'll start to see for yourself how it moves during the season. So let me scroll up real quick. Hey Fraser, how's it going? Fraser's question here is: I noticed more scalping recently on the lives. Is this because of what you were saying about the market being less volatile, and so we are doing smaller moves? So the reason we're doing more scalping now is because my trading changed a little bit. It didn't really change with regard to strategy wise, but it changed with regard to how often I trade. Previously, I would trade all day. So I can hold trades for longer. For now, I only trade, and I'll just put it up over here. So my trading style changed over the past 2 years, right? So for trading style, I guess. Previously, I would trade all sessions. Like I would just trade all day. Now I only trade mostly 6:30 to 6:30 a.m. to 8 a.m. So this is the main reason why it's changed really. I just changed my trading style a bit. The main reason I did this was because I just wanted more time to myself, more time to do other things. So I only trade between this period, and trading for a 1 hour time frame, you can't really take big trades because you're not going to find big trades within that time period. You're only looking for scalps, right? And I didn't really want to have live trading like for 6 hours. If you guys have been part of K2 for a while, you guys remembered early on I would trade from 6:30 or from 5:30 up until noon. So if you count the hours there, it's like 6, 7, 8, 9, 10, 11, 12, 7 hours. I would trade for a lot live with you guys for 7 hours nearly. And it's just draining, right? It's like working a normal job. The reason I got into trading is so I don't have to work, right? It's basically I'm working for an hour, I make my profit and I call it a day. So that's the main reason why I'm scalping more. I'm more of a scalper anyways. When I first started trading, I was a scalper. I only started trading intraday and swing because I was providing signals a long time ago. And if you guys have been around, you guys knew that my signals were off the 4 hour time frame. So that's the main reason why we changed mostly to scalps. And the thing is, scalps fit my trading style or my trading personality better because I don't like holding on to trades for too long. So it's not because the conditions have changed. I can still trade intraday. Like today, I was trading this right here. I still trade intraday. It's just not as much. So I traded this right here. I just exited earlier on this point because I started to see this double top forming. And the strategy that I applied for this was the intraday strategy. The trend meter here changed a bit. I don't know what happened. Let me see. That's weird. Yeah, I'm not sure why I took this entry here, but you guys saw me take it during the live. I took it during the live earlier today. I can't remember why I took it. I know I had this marked up. I thought there was a alignment here, but the trend meter actually was blue. But if you guys remember from earlier today, I took this trade here. I put a buy limit here. If you guys were on the live session earlier today, it failed, and I pulled out over here halfway with about 26 pips in profit. So I think the trade that I took right there, it doesn't show my, or actually it does. Let's see. No, it doesn't. Yeah, because I refreshed my, yeah. When you refresh this, it doesn't show like my profits, but I made about like 300 bucks off this trade. I was risking 5%. So technically if I held on to it and reached full TP, I would have reached, for another 30 pips, I would have locked in double that. So about 500 in profit, but I pulled out halfway right here because I saw a double top somewhat forming and I just pulled out, especially during the market swap. I don't like holding trades over the market swap. You have to pay interest on it. So that's why I pulled out, but this is one of the intraday entries that I took earlier. But yeah, back to your question, Fraser. The reason why I scalp mostly now is because I don't want to be on the charts all day. I just trade in the morning during the live sessions, and that's pretty much it. Sometimes I'll trade during Asia, but it's just like small scalps as well. But you guys can still take intraday trades. Like I took one here, and there's a whole lot here that come up. It's just looking at the bias and then looking for possible entries. Like for example, right here, UJ has been a buy for the past couple weeks. So like there was an entry right here. I actually took this one last week. This is an actual valid entry here. So on the 20th, I think I sent a screenshot for that. Let me see if I can find it. Yeah, so I took that trade right there, or I might have taken the EJ trade. It's EJ and UJ move pretty much the same way, but it was basically the same entry right here, I think on the 20th. Yeah, so I took this trade right here, EJ, your JPY on the 20th. It's the same trade here. You just you identify where the bias is going. You'll take an intraday trade like that. TP. Stop loss is set to previous swing, equal distance 1-to-1. You let it run and we'll TP. Right there. Right. I took the same trade for EJ. So you can still apply the same strategy. It just depends on like when you want to take it. But here's the trade right here. It's the same exact trade. EJ, same trade on June 20th. Long position. It's just a smaller TP, but the risk is the same. So it doesn't really make a difference. I'm taking 5% risk anyways. So either way, if I trade at EJ or UJ, if it hits full TP, same profit. So yeah, if you guys want to learn that strategy is also on the course. So if you guys open up the, let me see if I can pull up the course over here. And there's a lot of strategies you guys can apply. If you guys want to apply intraday, swing, scalp, whatever you guys feel like. I mean, there's a lot of different ones that you can apply here. So let me pull this up right here, curriculum. All right, so this is the course right over here. If you want to learn how to apply that strategy that I just showed you guys, you can apply it for pretty much any Forex pair. If you want to trade gold, I mean, it works on pretty much all assets. You would just go down to here, and it would be called the, where's that? The K2 Trades official intraday strategy. So if you pull this up right here, it'll give you the link right here. Click on that. It'll pull up the YouTube video, and then you guys can watch this strategy explained there. It's pretty simple. I mean, you're just looking for like bias. So for example, if you have a strong bias for a buy, you're just looking for these to match up. Because when you have a match up, odds of it continuing to push in that direction are very likely. So like, for example, here, it's been a buy for, past couple of weeks now for EJ. So you could have taken pretty much any of these buys here. Full TP, another one right here. Full TP. And I pretty much, these are set and forget strategies unless there's news happening. So for example, right here, I wouldn't care about these. This is fine. That's why I took this one and not these two previous ones. I wouldn't have taken this one right here because there was news right here. And you can see that it would have ran into your position. You've been some drawdown, comes back up, then it swings up in profit. For this one over here, there's no news for a while. It's all light news anyways. So there's literally no news during this period. So I would have been okay with taking trades here. Times when you want to avoid trades are when you have medium news, like these orange ones, or for sure these red ones. If you have these red ones, you definitely want to avoid the trades. So yeah, I think that's it for that right there. Let me see if there's anything else here that I need to cover. Let's see. Yeah, no problem, Fraser. Okay, so next question is from Patrick. So let's see. Patrick's question is, when they're that close to each other and you anticipate a price moving from one zone to the next, especially in those 50-point increments, like you mentioned in this morning on the live, do you often run your stop loss and profit to capitalize on catching zone to zone, or do you still aim to be taken out at 100 points? So it depends on the time frame you're applying it on, Pat. So let me just go over here real quick and show you guys. I'll just use this queen chart. And I'll show you guys how I identify liquidity. So say for example, this is your clean chart and you have nothing on the chart. The first thing you want to do is turn on the K2 high-low indicator. You'll go to your invite only scripts, go to the K2 high-low indicator, turn that on. You have your high-lows plotted on here. Depending on how you're marking this up, if you're going on the shorter time frames, I typically start at the 1 hour. If you're going on the higher time frames, I'll typically start on the daily. So for the daily, I'll go from daily down to the 10. And if I'm doing the 1 hour, I'll go from the 1 hour down to the 1 minute. And back to your question there, Patrick, it depends on the time frame. So if you're trading on the 1 minute, I still go for the 100 points. I typically always go for the 100 points. If I'm trading on the 10 minute or the 15 minute, you'll see a difference here. So now that you have this set up, I'll show you an example on the higher time frame, say the 15 minute. And what I'll do is I'm just going to go back a bit so that we could mark up liquidity and show you how the bigger moves happen here. So if you're doing these on the higher time frames, this is where you can push to further lengths because these candles here are bigger. So like when you take these trades, you're going to have a lot more space to, take trades and whatnot. So say for example, here you're trading the 15 minute, right? I can't really identify what the bias was. I don't think there was a bias yesterday. So, or this was on the 23rd. I just kind of went back in time. I'm not sure what the bias was for this day, but we're just going to say, for example, it was bullish. So what you're looking for is price at this area right here, right? Which is going to be area of liquidity. This won't be liquidity here because there's only one line. You need two lines for it to satisfy the requirement. So we have price pushed up a bit higher right here. Pushes up a bit higher right there. And this is an instance where I would do what you're just referring to, Patrick. So right here, we have this whole area of liquidity right here, right? At this point, you can do one of two things. Typically on the 1 minute, you're going for 100 pips. If you're trading on the 15 minute, you'll just go for something bigger than that. So instead of 100 pips, you can go for maybe 500 pips, right? Something like that. You probably do a 1-to-1 for 500 pips if you really wanted to. If you wanted to take it in a different direction, you can probably push it up to the next area up here. Generally, I like to use whole numbers, so I probably wouldn't write it up to this point. I would probably, or if I was to write up to this point, I would do what you just mentioned. I would move my stop loss and profit. So let's see how this moves as price continues to push along. All right, so price would hit liquidity right here. At this point, if your TP stop loss was 500 pips, that would be your range. Or if you wanted to do what you mentioned, Patrick, and continue to write it above, you wouldn't have taken it out here. You would have just had no TP. You would typically just have no TP. And then at this point, this is where you can either have your TP moved up higher, and then you can move your stop loss and profit, or you can just have no TP and you can continue to write it. So what I'm going to do here is I'm just going to keep moving this up, right? Move my stop loss and profit, let it push up higher. And then the area that I would move my stop loss and profit to would probably be the next area where price is wicked. So right here, just move it a little bit higher. If it pushes up higher like that, you can continue writing it up higher. There's a lot of different ways to do this. I mean, this stuff is like, there's no one way to do it. The thing is, I can explain to you how to do it one way, but everyone has different risk parameters, right? Like some people will get very nervous when you get to this point right here. I can't teach you guys to not be nervous. Everyone has their own trade psychology. So like, for example, here, some people have like thick skin and they don't care. They'll just let the trade run. For some people, they get scared and they just pull out. For other people, they'll just keep sliding their stop loss and profit. So as price continues to move up higher, you can just keep trailing it. And you guys know the feeling, right? When you guys are taking a trade like this, you guys are sweating, you guys are scared, you guys don't know what to do. You guys are blowing up my DM asking, hey, Sean, what do I do here? What do I do here? And I always tell you guys, do what you guys feel comfortable with, because there's a lot of different ways to manage these positions, right? You can move your stop loss and profit. And then right here, you probably would have gone stop down and profit right there, right? If you moved your stop loss, if your stop loss was still down here and you didn't move it up because you got greedy, then you probably would have gone stopped out at some point down here. I don't know. There's different ways to do it. What I'd recommend is just figure out what way works for you. For me personally, I don't like watching the trades. Like I don't like having to monitor the trades and having to move my stop loss and profit. So for me, typically when I take a trade, I just have a TP set. I'm taking a big enough lot size, so I do make a good amount of profit from these trades. So like if I was to take this here and pull out at 500 pips, like I use a 10 lot typically, right, for all my trades. So for my trades, I typically use a 10 lot on FTMO. 10 lot equals $10 per pip, right? So if I'm going for 500 pips, that's going to equal a 5,000 profit, right? I can't complain with $5,000 in profit. So I mean, it depends on like how you're trading, right? If you're trading a smaller lot size, obviously you're going to get greedy because you want to go for more profit. That's how everyone is. It's just, you know, it's just everyone's nature to feel more greedy when you're taking smaller lot size. So this is why I'm like content with going for a TP here. You know, if I was going to go higher for, I guess like 90 pips or 90 points, I could lock in more profit, obviously, but it's just more work. For me personally, I like doing, you know, the least amount of work and the highest amount of, I guess, profit with doing the least amount of work. So like I could have moved it up and then, you know, obviously I could have made more profit, but I'm pretty content and I have I have my own trading plan. So like I'm okay with making 5K because the thing is, you guys know that I have 5 accounts. So 5,000 times 5, you know, it's a lot of profit, right? That's why, like, for me, it's a little different. You know, I don't really feel the greed because I can lock in like 100 pips or 500 pips, you know, times 5, it adds up. So it's just up to your own preference, but there's different ways of applying it. Patrick, this is one way of doing it if you're on the higher time frame. However, if I'm on the 1 minute time frame, I don't really feel the need to push off, you know, that heavily. So if I go back to here, this is pretty much the market from 23rd. I just went to a random period again, and you draw the liquidity here. It's pretty much the same. Let me change the color so I don't throw you guys off. Change that to blue. So pretty much same difference here. I mean, everyone trades differently. For me, I don't really like to get greedy because when you guys start to get greedy, that's where you guys start to make mistakes, right? Like for me, it's the same process for every trade I take. You know, whether I'm taking a partial move or if I'm taking a full move, it's the same thing for me every single time. That's why I don't really get stuck in trades or have any crazy wins or crazy losses. I'm just like pretty much steady all throughout. So looking at price right here, if price was to hit liquidity at this point. Okay, so let's go over here real quick. So I drew the liquidity right there. Again, this is the 23rd. I don't know what the bias was, but we're just going to assume that it was bullish because that's what it was earlier. So for example, for me here, I personally would just get in and out right here, right? TP's right there for 100 pips. I personally would just pull out. Okay, it hits my TP. I don't have to worry about it. If you want to keep riding it, you can do the same thing that we did earlier. But typically, I would only do this on the higher time frame. So like again, right here, if you wanted to ride it further, you can do the same thing here again. Price pushes up higher. And if you wanted to wait to move your stop loss and profit, typically I'd want to like let price, you know, breathe a little bit. You can see that price is a bit more erratic here, right, Patrick? So like on the 15-minute, you didn't really see the spike back down right here. So if you move your stop loss and profit like early right here, this is why I don't really do it on the 1 minute, because if you move your stop loss and profit right here, the market is just too volatile on the lower time frames. So if you move your stop loss and profit right there, you get stopped out in profit. But you guys saw earlier from the other example on the 15-minute, price kind of gapped up a bit. So you probably wouldn't have gotten hit right there. You probably would have moved it when it was over here. And then price continues to move up. So this is the main reason why I don't really mess with it on the shorter time frames. If I'm trading on the 15 or the 10-minute, then yeah, I'll do that because you'll have a bigger sample to basically move your stop loss and profit for. On the 1-minute, it's really like hit or miss because these candles will spike up so fast and they'll spike down even faster. Like for example, if you move your stop loss right here again, you're gonna stop that on that following candle. You don't really have much time to make these adjustments. So it just really depends on how much you plan on using. So yeah, Patrick said, so basically ride it with a trailing stop loss, except on the 1-minute, take the 100 points. Unless you're close to a 50-point zone and still pushing, makes sense. Manage the trades as you see fit for risk reward. Yeah, definitely, Patrick. That's really what it is. But now I think during the summer, it's best to just pull out because you're going to get slower markets and you're not really going to, I mean, you can still catch the big moves, but you're probably gonna have to catch them on the higher time frames rather than the 1-minute. So let's see. All right, so that's it with Patrick's question right there. Let me just scroll up real quick. I want to make sure that I didn't miss anything else. Oh man, David said the market killed him today. Oh man. Yeah, I didn't trade after. I mean, I was talking to a lot of other people in the group and then talking to like people that I know who trade, their own groups. Everyone who has their own group, we're all kind of connected somehow. But yeah, I was talking to other people and the market was pretty crazy today. I'm kind of glad that I didn't trade after the live session. So the live session was somewhere around here. You guys can see how crazy the market, I can probably show you on the 10 minutes, easier to see. So this is basically where the market moved from today. And I heard some people, not from our group, but I heard from like other groups that some of their members like blew their accounts today because you can see how crazy the market moved back and forth. There was no clear direction. Market opened right here, right at 6:30. So this is opening price right here. You guys can see how volatile the market was kind of moving around violently. It pushed down, pushed up, pushed down, pushed up. This is just the 10-minute. If I go on the 1-minute and I just take off the high lows, you guys can see how like messy the market was today. It dropped below, pushed back up. It ranged for a while. This was during live, I guess. Yeah, this was during the live session where price kind of ranged. Dropped down, it ranged, but it ranged super heavily. If you look at the price movement here, so these ranges were pretty wide. They're like about 1,300 pips. And then it pushed up again over here. And then it just ranged again for another, 1,000 pips, pushed below, another range right here. It just kept pushing around and then going back into these big ranges. Typically, you want the range to be about like 500 pips. That's a lot better because you can catch the breakout, right? When price is ranging between this point, you can identify when it breaks out of it. Right here, you can't really identify it because it keeps pushing further out. Like you keep getting faked out as price pushes up, pushes down, and did the same thing here, same thing here. And then this is where I think a lot of people blew their accounts because people are trying to catch the bottom or the top. So not that it happened to anybody here in K2, but I've heard from other groups that they got kind of caught here at the end. Because what I heard was that people were trying to catch this. They thought when price dropped below this point, this range, they thought price was going to drop lower, but then they ended up getting stopped out because it came right back up. And when it came back up right here, what happened down here? They tried to do the same thing. Price broke down below again, and people chased that sell, and they ended up getting stopped out. So it's really important that you guys understand. I think the more important thing is to understand when not to trade. I feel like a lot of people think that they can make profit in every type of market condition. Even the best traders could understand that there's going to be some days where you should probably avoid the market, like today. So I'm glad a lot of you guys didn't really trade during the off session, or I mean off the live, because you would have gotten caught in a lot of this mess over here. It started to get really messy around here on 8 o'clock. So pretty much from 8 o'clock when we got off the live up until, and you can kind of cut these up. If you marked up the hours, like so from 8 to 9, 9 to 10. That's weird. There's a big gap right here from 9:55 to 10, 10:11. I guess the market froze right there for a bit. I wasn't trading, so I wouldn't know. 10 to 11, 11 to 12. You guys can see right here, if you just break up the market by each hour, you can see that there was no real movement. It was pretty much a big range right here from 9 to 10. It went down, but it was still ranging. From 10 to 11, it did have its drop right here, but then back from 11 to 12, a range. Then again from 12 to 1, market close. Pretty much a range again right there. So it's pretty much just ranging all throughout. Right here, we got off the live range, range, drop, range, range, and then it closed out in another big range right here. So I can see how you got messed up today, David. I wasn't following the market, but now that we've actually looked at it, I can see how you got messed up. You probably got caught in some of these moves here. So other than that, let me scroll up real quick. Yeah, Dave, for your 100K count, you should probably not use a 10 lot. I'm using a 10 lot, but my count's 200K. So you should probably using half of that. Biggest lot size you should be using with a 300 pip stop loss would be 5 lots. But you shouldn't use anything higher than that. You should probably use something smaller if your stop loss is anywhere more than 300 pips. Scrolling up real quick, let's see what the next question is. Next question is from Jason. Jason's asking, Sean, how are you finding liquidity zones? I'm still confused on that. It's pretty simple. I mean, the way that you'd identify liquidity is by turning on. So I'll show you guys again here how I mark it up. So I'm gonna go over here and just go to, let's go to a random time or a random area right here. So I'll just go back to here because I can see that there's a lot of liquidity that's getting built up around here. So what I'll do first, say this is a clean chart. You have nothing on your chart. The first thing you're going to do is turn on the K2 high-low indicator. If you don't have the K2 indicators, you're not going to be able to use this, right? You need the K2 indicators to identify this. So here's the clean chart. There's nothing on the chart. You turn on the K2 high-low indicator right here. You have the high-lows marked up on your chart, right? This is how you're going to identify liquidity. If you don't have this indicator, you can do it by hand, but I can almost guarantee you're going to do it wrong because, like, so let's take this off right here, right? You guys can see that it's really difficult to identify these high lows because price will drop and there could be a high here. I mean, there could be highs everywhere, but when the market's choppy like this, it's like almost impossible to really identify exactly where these high lows are sitting. So that's why it's recommended to use the K2 high-low indicator to identify these points. So when I'm identifying liquidity here, if I'm scalping on the 1 minute, I'm going to go on the higher time frame and make my way down. So here's a 1 minute. I'm going to start on the 1 hour. You guys can see we have the high lows here. I'm going to do this and just mark up where all of these high lows are sitting. So for the 1 hour, we have one right here, one right here, one right here, one right there, one right there, 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 and there. You're basically locking, you're marking up all of the high lows where price has not touched yet. So price has touched these areas right here because price is pushed below it. So you're not going to mark up these high lows. You're going to mark up areas where they haven't been tested yet. And that's where liquidity is being created, because when price does hit these areas, typically price will bounce or it's going to break through it. So we have this on the 1 hour. I usually go down to half of the time frame. So if I do the 1 hour here, I'll go down to the 30-minute. We have new levels here that have not been marked up. You can see that this 30-minute lines up with the 1 hour, which is perfect. Next, we have these lower areas over here. So mark this up, this up. These right here have been tested already. You can see because price pushed down below, so we're not going to mark those up. This one right here, this one right here. Move down to the halfway, 15-minute. Mark this up right there. These right here haven't been tested. Mark that up right there. This one. That's it for the 15-minute. Go up to the 10-minute. Same thing again right here. You do the same thing. Just keep marking them up as you go higher until you get back to the 1 minute time frame. Level right there. This has been tested. This has been tested. Mark this up right here. Mark this up right there. There. We're done with the 10-minute. Go up to the 5-minute. All right. We got these marked up right there. There. There, and that's about it. Now to the 1 minute. This is where we'll be trading, looking for liquidity. Mark this up right there, right there, right there, there. There, and I think that's about it. So once you have that marked up, you already know where the liquidity is sitting. At the end, you can clean this up. Like for example, you can see these kind of overlap. I'll just delete this one, delete this one, delete this one. So once you have liquidity marked up like that, you're just looking for these two areas, like basically two lines that are close enough to each other to be identified as liquidity. So I probably wouldn't consider this liquidity, but this area above it, I would consider this liquidity. So when I see price push up to that point, I'm expecting it to push up higher. And that's where I would take a trade. So using this as an example, we're gonna push it forward. You can see price pushed up right there. I'm waiting for it to hit this point. When price hits this next level, this is where I'll take the entry for a long position and then basically write it up for 100 pips. I'll push it a little higher. And then right there, you can see the liquidity. So you can see why this is considered liquidity, right? You see how price breaks right through it? That's because there's liquidity sitting right there. We've already identified it because we had the lines marked up, right? I already marked it up before it even happened. So if you go back, you can see that these candles are barely moving. But as soon as price hits this point, you see it just blast right through it. See that? That move right there? That's liquidity. And it's like, it's not a coincidence, because if you go back and just back test this stuff, I mean, it looks like it's a coincidence, right? But now that we have lines marked up here, you already identified that this was going to happen. Because typically when liquidity hits, it just pushes up to the next level. And then from this point right here, it'll either keep pushing up to the next level or it'll come back down. So it pretty much, I mean, it's like a little cheat code, right? Because you're kind of gaming the market. So like the thing is, a lot of people don't know how to identify this stuff. You know, some people are asking me if I can explain, like Patrick asked me if I can explain order blocks. I personally don't like, or I don't even have a way of identifying order blocks myself, because it's such a subjective way to identify, right? A lot of people will say, okay, this is an order block. Like I've seen so many people try to explain order blocks, like, oh, this is an order block, or they're like, oh, this is an order block, right? And if you watch like different videos of people explaining order blocks, everyone identifies it differently. So for me, when I identify liquidity, it's really hard to screw this up because everything is marked up for you. There's no subjectivity here. You're literally just drawing the lines as they go along. So like I showed you exactly how I did it before. There's no way to screw this up. Like the lines are, like the high lows are already marked up for you. You're just putting lines where it's telling you where the high lows are. When you're identifying, you know, order blocks or supply and demand, everyone, you know, they identify these things differently. So I've seen videos where one person is identifying how to identify order blocks, and then this other guy in another video is trying to explain the same thing, but they contradict each other. So I personally don't use order blocks. I mean, these liquidity zones might be considered order blocks to some people, but I don't call them order blocks. I just call it liquidity. So depending on what you guys want to use, I think this is probably the easiest and best way to identify where liquidity is sitting, because there's no guesswork here. You know, the high lows are already marked up for you. You're just marking them up on different time frames. And then you already have pretty much a framework to follow. Like you can literally do this on any time frame. You can like go to any time period. Like for example, right here, like we'll go back to like June 24th, right? And you can do the same thing that I just showed you guys. Like you literally do the same thing. I can go back to any other time period. Like I can go back to like, trying to see like, okay, we'll go back to like some random period over here. I'm only saying this because I see areas of liquidity right here. So we'll go back to like June 21st, right? You guys do the same exact thing here. It doesn't matter what date it is. You can go back like years behind. This same analysis works out perfectly fine. You know, as I mentioned, you can do this by hand if you want, but odds are you're going to misidentify where liquidity is sitting. So I'll do the same thing here that I did earlier. It doesn't take very long to identify liquidity. It's really just turning on the indicator and marking up the high lows. So I'll do the same thing here again, just to show you guys another example, to show you guys how easy it is to identify liquidity. I feel like a lot of people try to overcomplicate this a lot. It's not that difficult. It's really, if you have a process that you guys can follow, like what I've created here for you guys, it pretty much takes away all of the difficulty of identifying liquidity. Because I know it is hard to identify from scratch. But if you use my indicators here, there's a reason why I created these indicators, to make it easier for you guys to use. They're like training wheels, basically, or a cheat code. A lot of people call them cheat codes. You know, you can call it that if you want. Because it pretty much does all the work for you. You're just pretty much drawing lines there. So everything that I create for K2, guys, there's a reason for it. I'm not just creating random indicators for no reason. Everything here is made for a specific reason. Like if I'm looking for liquidity, I'm gonna create an indicator that's gonna help me identify liquidity. I'm not just creating a high-low indicator for no reason. You know, there's a ton of indicators out there, but a lot of them are pretty useless in my opinion. All the indicators I create are for a specific reason. Like we have some sort of utility for each indicator, and they all help one way or another, depending on what you're looking for. So again, right here, I've marked up the liquidity on a random date, June 21st. All right, there goes the 1 minute. So we've marked up pretty much all of the liquidity here on the 1 minute. I'm gonna clean this up a little bit and take off all these random lines that I might have accidentally drew. And then again, right here, same thing, right? We have liquidity sitting right here. We have liquidity sitting right here. I probably wouldn't consider this area of liquidity. It's too spread out. But if price does hit this point, probably expecting it to push up at least 100 pips. Or you can catch it up here. I mean, it just really depends on your preference, your risk parameters. For me personally, like I mentioned, I only like going for quick moves because it's enough for me, right? So again, right there, price hit that area that I just marked up. It didn't hit the TP yet, but it did hit liquidity. Trying to drag this over. It's okay, I'll just draw another circle. All right, so we hit that area there, blasted right through, and look where it hit, right? It's not like I randomly drew these lines here. Like I didn't draw them after the fact. I drew these lines before this movement happened. So I drew these lines before, and you can see where price goes to, right? There's no coincidence here. Like these high lows are already placed before this movement even happens. So that's the difference between using my indicators and identifying order blocks after they happen. This is a thing that I see a lot of people do, and they try to trick you. You know, I'm not going to name any people who teach this way, but a lot of people are scamming when they identify order blocks, right? They'll identify order blocks after it already happened. So the movement would have happened right here already. And what happens is they're like, oh yeah, I saw an order block. I'm sure you guys have seen this before. People do this all the time. They'll say, oh, I would have taken a trade here because I saw something right here, right? And they try to trick you to make you think that they saw something, but the movement already happened. So they're like, okay, I would have seen this. They just rewind. And then they play forward and they're like, oh yeah, I saw an order block here. I drew this, that, and whatever. And then they push in like, oh yeah, so I identified this before it happened. A lot of the times they already know price can go in that direction. I've identified this before it actually happened. So I drew these high lows before this push up has happened because I went back and I drew all these lines before anything even happened, right? Because these lines are already in place. So using this right here, you'll see targets that you can reach for. This point, or this point up here. This has all been drawn. The data is already there. You guys can go back and you can see where these high lows are. Like you know, if you turn this off, you can see that these points were already drawn up, like they're already lined up real time. So when price does push up from that point, you can see it pushes up, it goes to that next level, goes to that next level. And you can see where these price, see I have this line drawn up here already because I already had it drawn up before it even happened. So this is why it makes it a lot easier for you guys to draw these up, because it takes out the guesswork. You're not kind of guessing where order blocks are sitting. You're not guessing where supply and demand is. It's already lined up for you. Not to say that this is going to happen every single time, but this does kind of level out the playing field. You play with an edge. Like it's like you're gambling, but you're the casino, right? The casino already knows what their odds are. For us, we know where our odds are too, because we already have these lined up here. So hopefully it's starting to make sense for you guys. And this is the main reason why I created these indicators and why we use them in this certain way. So let's see. Patrick said, like when you responded in the email back to me earlier, it's so subjective. After watching hours of videos, I still couldn't understand the process because the info in the videos just didn't line up. Yeah, no, definitely, Patrick. Yeah, Patrick said using the high-low indicator is so much easier to simply identify liquidity zones and where stop losses are sitting for us trading in the opposite direction. Yeah, exactly. And that's why I trade in the direction of bias. So like, for example, here, you can see how price is kind of pushing down from this point. In this situation over here where price is pushing down and we have a bullish bias, then you're basically just looking for price to push the upside, right? That's kind of what happens here. And then as price continues to move along, you have all this liquidity right here, right? Down on the bottom. So let's see if these liquidity ever get hit. So let me just keep going along. Doesn't look like it gets hit anytime soon, but I think at some point in the future, it does come back down. So these same areas of liquidity that we drew earlier, price is now reversing to the downside. And you can see right here that price comes back down and hits pretty much all these areas again. So these lines here are not like random lines. They're placed there for a reason, because you can see price comes back and retest that area. And you can do this as much as you guys want. If you guys want to practice this and just back test, you guys can literally pull up any day that you want. Like you can go back weeks, months. I mean, however far you guys want to go back. You know, if you guys want to go back to like June 1st or whatever, this is what you guys can do in your free time. Just, you know, go back and draw whatever you guys want to draw here. So if you want to go back to like June 5th and you want to practice this liquidity, you just pretty much do the same thing. Turn on the K2 high-low indicator and then, you know, draw your liquidity. And I do this every morning. If you guys have been on the live sessions, you guys have seen that I do this literally every morning, because it pretty much gives us the framework as to where to follow for the day. But yeah, enough with that example. Let me see if there's any other questions here that I'm missing. Yeah, no problem, Jason. Glad I could cover that for you. Let me scroll back up. I want to make sure I didn't miss any questions. Sorry, guys. PC's asking, so you would enter 100 pips before the start of liquidity zone? I enter at this, like at the start, not before it, but at the start. PC. So like, for example, here, if I was to enter any of these trades, I already have these marked up right here. If I was to enter a trade here for a sell, I would enter at the start of the liquidity zone, not before it, not after it, but right at it. So like right there, that's where I would have entered it. I think there was another part to your question as well. Scroll down real quick. PC asked, sorry, one second, guys. I'm losing my voice. All right, PC's asking, will it be a good idea to just place a buy stop or sell stop at the liquidity zones in advance? Also, have you tried this during Asia session? Yeah, pretty much all my trades during Asia session are all liquidity pushes. Or what I do sometimes is that they're lined up. So say, for example, we get a V3 or V1, some type of variation or any type of strategy, really. If we have those types of entries that come up, I will typically use the liquidity areas here as a guideline. So say, for example, I know there's no entry here, But say, for example, we have a pivot scalp entry that comes up. Like say this doesn't close with the sell signal. It pushes below, it pushes up a bit more, and then it comes back down. And say we get a sell signal somewhere over here. Say the trend meter is red, we have a pivot scalp entry. If we have something like that, then I'm like, okay, I'm for sure going to take that pivot scalp entry, because if I take that pivot scalp and it lines up with the liquidity zone, you know, odds of it hitting TP are almost 100%, right? Because you're basically lining up multiple strategies with one. So I personally don't necessarily apply liquidity by itself. I'll line it up with something else. So if I have a pivot scalp entry, a variation, a high-low scalp, a triple confluence, whatever I could find, you know, a variation V1, whatever type of entry there is, I'll tie that with a liquidity area. Like I'm not necessarily using it by itself, if that makes sense to you guys. Because if you already have an entry, like for a pivot scalp, you know, typically when that happens, the trade has like almost like a 70% chance or higher of hitting, right? If you tie that in with liquidity, you're almost 100% going to hit, because you're going to have at least 100 pips. Like you're going to have liquidity pushing that direction. With your sell signal, you're for sure going to hit your TP. So that's how I personally use it. But I don't necessarily just like, that's why I was like, kind of going back to your question about like the buy stops and sell stops. I don't just enter it just because. I'll enter it if there's some sort of entry. Like say, for example, we have a V3. Let me see if I can find an example over here. Okay, so this is an example over here that's just kind of perfect. I don't see if say it's necessarily sorry, let me go to a clean chart. I don't want to mess this up, because this is the actual chart. I do see an entry right here for a V3. Where was that at? Let me see. Timestamp for that was, I just saw it right here. Timestamp 11:50. All right, so 11:50 right here. Here's an example of me applying a V3 in conjunction with liquidity. This is like, if you see an entry like this, you're almost for sure going to hit. Like there's like, I mean, it's probably for sure. Like when I see something like this, I go like full lot, and I just, I let it run. I don't move my stop loss or anything. I just take it with a DOM, and then I let it run. So using this as an example here, I don't know what the bias was around this time, but I'm just going to show you this. Like if I do see something like this and everything lines up. So for the V3 right here, confirm overall bias, we're just going to say it's a sell. I think it was a sell because it was a sell earlier today. So we'll use this as this tool's weird. Okay, there we go. I don't, okay, I don't know what's going on with this here. I'm trying to use the right arrow. All right, whatever. I'm not going to use it. Anyways, we're just going to say it was an overall sell bias. We have the high right here with the green candle, followed by a red candle, pending sell signal. So we do have a possible V3 right here, right? Just using this as an example. Possible V3. It might be a little tighter. Okay, so the example is actually not that great because it's kind of far, but just using this as an example, say we had another liquidity area right here, right? I mean, technically there is a liquidity area right here, but it's kind of wide. So I wouldn't have used this as the area of liquidity. But let me see if I can find another one here. No. Okay, just say this was a V3 and it ran. And say, for example, you had an area of liquidity, like say this was the liquidity right here, right? Say if it was tighter. I mean, it's not super tight right here. Or actually, here's another one. I messed it up. I was trying to go for this one right here. Okay, so this is actually the example I was trying to show you, PC. So this is actually a really good example right here. So you can see how there's liquidity right here. This is a perfect example of what I was just referring to. So right here, we do have a V3 because there's a, like, actually it's not a V3 because there's no pending sell, but just using this as an example, say for example, there's no sell signal here, and this is a V3 and it cuts into this area of liquidity, right? If you have that right there, you can line this up 300 pips. So if it's hitting this area of liquidity, you already know price is going to hit this point, right? And odds are if it continues pushing, it's going to hit this point down here. So if you were to take this V3, see how it pushes down lower, hits TP, hits that point right there, and then pushes down to the next level right here. So that's when I would use it. I don't just use liquidity by itself. I use it if I can line it up with another strategy. It basically just gives you an extra boost of confidence whenever you're taking any specific trade. I know this wasn't the best example, but I was just trying to show you, like if you had a V3, a V1, a V2, a high-low, pivot scalp, whatever you want to call it, and you have liquidity sitting right there, it's almost guaranteed to push right through it. So whenever I take a trade like this, I almost always go with my full 10 lot and I just let it run to wherever I needed it to run to. So yeah, no problem. I know it's probably going to be a big eye opener for you guys, because now that you guys have seen that, you guys can use that to your advantage. Like for example, over here, we already have price hitting liquidity. It did hit the area of liquidity right here, like I mentioned. I should have just taken the trade. This is what I was just referring to earlier. I said, okay, if price hits this point, it's probably going to push down to this next area. I drew this up before the market opened. So price is right here. This is what happened before the market reopened from the spread. And you can see that when price did hit that point down there, it pushed down to these other levels. So this is where I mentioned it takes out the guesswork, because you already have these lines drawn up before it even happens. It's not like it happens after the fact. It happens as it happens, real time. And that's the power of these areas of liquidity. Yeah, no, definitely. PC said absolutely great to align the strategies to the liquidity zones. Yeah, whenever I see that, that's usually where I'll take a trade. That's why sometimes when I'm taking trades on the live session, and there's sometimes where I just take a trade, but it doesn't line up with all the requirements, but there's a liquidity zone right there, odds are it's probably gonna hit. So in some instances like that, you can disregard, well, I don't want to give you guys bad habits, but when I see something like that, I'll pretty much ignore the first requirement, because I'm pretty sure it's going to hit, you know, a lot of the times. So not that I'm recommending you guys do that, but I'm just telling you guys that's what I do sometimes. That's why sometimes during the live, I'm like, oh, I took a speculative trade. The reason why it's speculative is because all the requirements aren't met, right? If you have all the requirements met, then it's going to be a valid entry. If you're taking it without the bias, then it's not a valid entry, it's a speculative entry, because you're kind of taking a trade based off like what you would apply here, but it doesn't meet all the requirements. So hopefully it's starting to make a little sense now when you guys see that I take these speculative trades during the live. They're not really speculative because I know the direction, but they are kind of risky. That's why they're considered speculative, because they don't fit all the requirements. And there goes another secret. I try to keep these secrets to myself, but it's hard to keep it from you guys because you guys have my tools here. So if you guys are using my tools, you guys are able to see what I see. And it's just a matter of mastering these tools, right? You know, if I see another thing that I need, I'll create another tool and you guys will have access to it. So you guys can trade exactly how I do. But there's a lot of these different like little things that I apply that make a big difference when you guys are trading live. So other than that, yeah, Patrick said, I'm basically starting to see liquidity zones as magnets or targets for price action to potentially reach when a valid entry is in play. Yeah, and this is exactly how Kevin applies it. So you guys have seen Kevin's profits, right? Like he locks in some pretty crazy profits because that's what he does. He pretty much aligns the liquidity zones, and then he uses price action or like whatever type of strategy he's applying, and he'll pretty much ride them to the next zone. So if he's taking a pivot scalp, he'll ride that to the next zone. If he's taking, you know, a variation, he's riding that to the next zone. He's not cutting himself short by going to the requirements, which is, you know, typically 100 pips, 300 pips, 500 pips, etc. The only reason I put those requirements there, like, so this right here. So say, for example, you're taking a pivot scalp. The reason why I have these requirements here is so that you guys don't get greedy. The thing is, if once you guys get better and you know how to let your trade breathe a little bit, or you can ride it to the next zone, then you can stop using this here. But for now, until you guys have mastered, the bare basics, you guys should just follow this, because this will almost guarantee you 100 pips almost every time. So there's always going to be different ways to apply the strategies. I'm just setting the foundation and the basics for you guys so that you guys can build off it. Everyone has to start somewhere, and you guys, you'll never get any better until you get the basics down, because everything is built off the basics. It's the foundation for you guys here. But yeah, other than that, let me see if there's anything else that I'm missing. Nice. Yeah. So Rashida said she tried the buy stops and sell stops, and it works like a charm, which they do work sometimes. But I wouldn't necessarily just leave it there, because sometimes you'll see those random spikes. Like you'll have liquidity, and then you have a sell stop and you forgot about it like an hour ago. It comes back and hits it, but then it spikes back up. So that's something to keep in mind. If you guys are using buy stops or sell stops, make sure that you're actually paying attention and you're not just leaving it there, because say you have an area of liquidity right here, and then price will push up for maybe an hour or so. And then when price comes down, you forget that you have that sell stop there. It can come down to that point and bounce right off. Right? So I would only do that if you have a direction of bias. That's always going to be key for you guys to keep in mind. Let me see if there's anything else that I'm missing. All right, question from Frazier. Frazier is asking, thanks for pointing out that you can backtest liquidity pushes. I'll practice this. Do you have the best practice key things to focus on when backtesting? Not really, Frazier. I think for backtesting, I would recommend that you don't. And this is the main reason why I personally don't backtest, because when you guys backtest, you guys are usually focusing on all the good and not the bad, right? What I'd recommend is to take into consideration the wins and the losses. Because I've seen a lot of people who backtest and they only look at wins. It's crazy. It's you'll never learn that way. I'll see people go through backtesting and they'll be like, okay, they'll see a couple wins here, and then they'll say, for example, they have a win here. Or I'll do this. So there's a win right here. And this is just using a different strategy, but this is just going to be a good example to show you guys. So if you guys go back and backtest, you guys will see that you'll find a lot of wins. The thing that you have to take into consideration are losses as well. You learn more from your losses than you do from your wins. A lot of people fail to realize that. All right, I'm looking for a lot. I'm purposely looking for a loss here. Okay, there's a loss right here, right? All right, so there's a loss right here. What I see people do a lot when they backtest is they ignore the losses. So they'll have wins, and then they'll get to a loss here and they'll just ignore it. They'll be like, okay, that was probably an accident. I probably shouldn't have taken that trade. And then they don't analyze the loss. So they go over here and they're like, okay, I just keep winning. I keep winning. They think everything's great. And then what happens is when you guys do it live and you have the loss, you're completely lost because you don't have any idea why you took that loss, right? So whenever you have a loss like this, make sure to go back and actually see what caused that loss. So for example, right here, there's a loss here on the 24th. What you can do is you can pull up the news. You can go back to the 24th. And you're like, okay, what was on the 24th that could have caused me to lose that trade? So that you don't make that mistake when you're trading live. So you can see over here that we had the biggest red flag is going to be that it was a Friday. So you're like, okay, I had a couple wins here. I had a loss here at 12:30. Why was there a loss? If you guys can think of it, I can instantly tell you why there was a loss. It was, for one, it was Friday and it was getting close to market close. So when it gets close to market close, you get a lot of manipulation towards the end of the market session right here, because a lot of people are trying to pull out of the market before market closes. You can see right here, obviously market close at this point. Or where's that? Yeah, so market close right here. Typically, the last 2 hours of market is where you see a lot of manipulation. So one word of advice, if you're going to go and backtest, is to is to take into consideration the wins and the losses. Don't just focus on the wins, because obviously you're going to see a lot of wins. But one thing that you want to pay attention to are going to be the losses, so that when you do trade live, you'll understand when to avoid the market. Let me see if there's anything else here that was a red flag. So let's see the sessions. No sessions there. Opening price was down here. There's news at 7. So there's nothing really else here to identify, what could have went wrong. The main thing here is that it was so close to market close that's why I would have avoided these trades. Even though you would have had like a lot more wins over here, I still would have avoided these trades because I stopped trading. Well, me personally, I stopped trading at 8. But if you're trading on a Friday, you typically want to stop trading around like 10. 10's like the cutoff. Because you can see right here, price kind of dies down from 10 o'clock. Because a lot of people are already out of the market. And then towards the end, you just have this like weird push to the upside. And that's something to take into consideration. So let's see. Yeah, and another thing here that Patrick confirmed. So Patrick said, hard to confirm fundamentals and sentiment while backtesting. I found it much easier to play with these strategies live on demo counts instead. And I agree with you as well, Patrick. It depends on what type of strategy you're applying. Fraser, if you're just learning how to apply the strategies, then great, you can backtest. But if you want to practice it under real market conditions, you're going to have to do it real time. Because as Patrick said, you can't confirm the overall bias. So if you're applying any of these scalping strategies, you need to, I don't know how to fix this thing. Let me try to refresh this. I don't know why the arrow doesn't change. There we go. Okay, so you can't confirm the overall bias by backtesting, because if you go back on a random day, you can't pull up retail sentiment from like 10 days ago, right? You can't pull up fundamentals from 10 days ago. You can pull up technical bias, but everything else you can't pull up. So if you're just learning the strategies, which you are, because you're new, I know you just joined today, it's okay to backtest, but it's going to be hard for you to really confirm what the overall bias is during that day. So yeah, if you're just applying the strategies, then master everything after that. But in a lot of instances, if you have a loss, it's probably because you weren't trading the direction of bias. That's gonna be one thing to keep in mind. Yeah, Fraser said, what if I pick a random day in the past and trade from opening? Yeah, you can do that. You can definitely do that. That's one way to do it. But you would have to stick within that parameter, right? From like 6:30 to 8, because we confirm the bias during that day. So that would be one way of doing it. But it's going to be hard for you to, like what Patrick said, it's going to be hard for you to pinpoint exactly where that entry was. But yeah, that's one way of doing it, Fraser. And I've seen other people do that as well. That's probably the closest you'll get to a solid back test. But realistically, you should probably do it during real-time conditions, because it's going to help you build your trade psychology as well. The strategies are like, it's just one step of applying the strategies. Applying the strategies is like one step of really getting it. The other main thing is your trade psychology, because it's different when you're back testing and trading live. Your emotions are gonna run high when you're trading live, especially even if it's a demo account. You're probably going to get nervous with your entries and wonder what's going on. You're not gonna get that with back testing. All right, so I think that's it with that question. Let me see what else we've got over here. Scroll up real quick. Let's see what else I'm missing. All right, let's see. Yeah, no problem, Fraser. Glad I could help you with that. All right, guys. So I don't see any other questions in the chat. If you guys have any other questions, feel free to put them in the chat. I'm here to help you guys out. So like, I can go on for as long as you guys want. But I just don't see any other questions in the chat. I don't know if there's any concepts, any strategies you guys want me to cover, any questions regarding trading. I'm here to help you guys out. So. unless there's any other questions, I mean, we might be wrapping this up soon. But let's see if there's anything over here. Yeah, I don't see anything on Telegram either. So, all right, guys, I'll sit around for a bit. If you guys have any questions, feel free to put them in the chat. Otherwise, looks like we'll be wrapping this up shortly. Tomorrow, we'll be having a one-on-one session. I'm having it with Peter. So Peter scheduled his one-on-one with me at 12:30 p.m. So if you guys want to sit in on that mentoring session, the link isn't going to be posted up, but if you guys want to sit in on it, you guys are more than welcome. The link will be, so in order to get into that session, just make sure that you're following the YouTube channel. Let's see if I can pull it up here. Just make sure that you're following the YouTube channel, guys. If you guys want to have access to that, just go to the YouTube channel, youtube.com/K2Trades. Make sure to subscribe. And then when I go live tomorrow with Peter, you're going to get an email from YouTube telling you like, hey, Sean's live right now for a mentoring session. And you'll click on that link, or you can just go on the K2 YouTube channel and it'll have a live mentoring session button right here where you can just click on it and watch. From there, I'll be going over specifics with Peter. I think he wants to cover the V3. Let me see what else he wants to cover. He did message me so that you guys can have a better idea of like what's going to be covered. Let's see. Check my emails. Okay, so Peter wants to cover, he said strong focus on V3 in London session, high quality V3s versus low quality, relevance of pivots in V3 and the trading plan. So we'll be going over the V3. He likes to trade during London because that's his time zone. So we're going to be covering that, using the pivots to help identify rejection points or trend, and going over his trading plan. So if you guys want to sit in on that, feel free. It's going to be posted here on the YouTube. It's not going to be posted in the group because it's technically one-on-one, so I can't be answering any other questions. It's just going to be between me and Peter. But if you guys want to sit in on that, it's going to be posted on the YouTube. So just make sure you're subscribed to the YouTube. It's free. And make sure that you turn on your notifications so that YouTube will email you when I go live. So other than that, I think that's it for right now. Let me see. There's another question here from Rashida. Rashida's asking, is that a V3 on the 1 minute? There is a V3 here for, well, let me see. Your message came at 3:20. This looks like a V1 to me. I don't think it's a V3 because the stop loss isn't wide enough. So let me go over here real quick. So this is a V1. And here's a V3. So for the V3, we needed to have a minimum stop loss of 300 pips. It doesn't look like 300 pips to me. Yeah, it's definitely not 300 pips because it's way down here. So it's definitely not a V3. It looks like it could be a V1 though. So it looks like a V1 because there's two, it's a double wick rejection off that low. So yes, it is a V1. One thing that you need to confirm though would be the overall bias. I don't think we have a bullish bias right now, so it might not be a V1. So to confirm the overall bias, we'll look at retail sentiment. Retail sentiment is indicating, let's see, 52% long. So yeah, we're not looking for any bias right now. Looking at the fundamentals, they're not very strong. They're up like 8 points. So I personally wouldn't take this for a V1 just because, I mean, if there was a small bias, like if retail sentiment was indicating like, say if it was like 55% short and then we had this up at least like maybe 50 points, then yeah, I'd have a weak bias. It'd still be a bias, but it'd be a weak bias. And then yeah, I would take that for a buy. But right now it's still indicating a sell. or not really a sell, it's more like indecisive. Because right here, this is indicating a sell, but it's really weak. The fundamentals here are just not really pushing anywhere. It says 17 points in the green, but it's kind of really weak. It's not anywhere above 50. Typically, you want it over 100, but right now it's only 17 points. So I personally would not have taken this as a V3. And you can see prices making its way back down as we see. So yeah, I would probably look for sells, guys. I think price is going to keep dropping. I think this push to the upside is done right here. And I think price is going to be tumbling its way back down. But I think for right now, price is just going to go sideways. I don't think it's really going to push down or push up very much. It's just going to go sideways until maybe, I give it maybe 2 or 3 hours. And then we'll start to see some volatility once you know, Asia session is in a full swing. Yeah, Patrick said price has been in a 20-point range for almost 3 hours. Yeah, it's been there for a while. There's not really much direction right here right now. So if you just map this out right here, yeah, it's pretty much just been ranging this whole time since open. Let's see. Frazier said, I'm guessing London session has less volatile than New York. I'm from Scotland, so my ideal time zone is London too, but I'll be trading with you guys in New York until I know what I'm doing. So Frazier, if you want to trade during London, you can trade the DAX. The DAX mirrors US 30, but you can still trade US 30. There's still volatile during London session, but you're not going to get a smooth move because it's not a London asset. The stock exchange is technically still closed. So if you look over here, let me go here actually. So I'll mark up like London session from yesterday. So you can see how the market, it moves, but it moves kind of crazy during London. So this is London session up until New York. London opens midnight my time. So you can see how price, there's volatility there, but it's not very smooth, right? It's like, for example, right here, price pushes up for the first hour. I typically don't trade the first 2 hours of London session if and when I used to trade London session before. So you can see right here, the first 2 hours is kind of tricky because the first hour price pushes up and then it comes back down. And then after the first 2 hours right here, you can see that it now has a direction, right? So it basically sets up for the move up until New York session. So if you are trading US 30 during London session, I typically don't recommend trading on open because you see this crazy movement. It's just like the breakout for New York, except it doesn't really have a catalyst because the market's technically closed. So for this right here, you can see it's moving pretty crazy. It pushes up, comes down. But if you wait for the first 2 hours to pass, it starts to move smoothly right here. So if you want to trade London, you can trade US 30, don't get me wrong. I've seen people trade US 30 during London and it works perfectly fine, but I would recommend possibly trading the DAX. I think the DAX would probably, the DAX 40. It used to be DAX 30, but now it's DAX. I'm trying to see what UK 30. Yeah, I don't know what symbol is it anymore because it used to be DAX 30, but it's not DAX 30. Might change to DAX 40. But let me see. I mean, I guess you could use this DAX 40, or I don't know. Sometimes it's called German 30. This was the old one. I don't think it's been updated. That's weird. It's still running. The DAX isn't the DAX 30 anymore. It's now the DAX 40. So German 40 index. But you can see it's the same thing. They just never updated the number. So you can see the price here is pushing like this. You go to the DAX 30 or German 30, it's the same thing. It's like literally in the same spot. So they just never changed the symbol. But you know, from my knowledge, it's the 40 now. It's not 30. It used to be 30. It used to be lined up just with US 30. But the DAX is now yeah, honestly, I don't know because I don't trade it anymore. I'm trying to think what else would it be called. I'm pretty sure it's German 30. So if you were to use that and we go over to like midnight, you can see it pretty much has the same movement. So the same thing that I showed you for US 30, it moves almost identical. So from midnight up until 2, see how it has the same move? It pushed up right here, and then it pushed down. And then from London up until New York open, you can see how much smoother it is. It's like you can take a sell here and not even think about it. Very smooth drop to the bottom right there. This is why I like trading. Well, why I used to like trading the DAX. I don't trade anymore because I need to sleep. But you can see here it's smooth drop right there. Compare that to US 30. Now what happened? Oh, it's the same thing. So again, right here, same thing from midnight up until 2. It's like literally here. I can even put 2 charts here. Let me see if I could. Sorry guys, I was trying to mark it up here, but it doesn't copy it over. Anyways, so same movement here. Push to the upside, drop back down, and then from here up until 6, market open, 6:30. It's still a drop to the bottom, but it's not as smooth. You can see that it's kind of choppy. Right? It's not necessarily just a smooth push down. It pushes down, then it pushes back up, and it pushes back down. Going back to the DAX, it's a smooth push. So you might just want to trade the DAX if you want to trade during London. You're gonna have better entries. But all right, other than that, guys, I think that's about it. If you guys have any other questions, feel free to put them in the chat. Otherwise, I don't think we've had questions for a while. So I think that might be it. So let's wrap this up. If you guys have questions, feel free to email me or message me on Telegram. Otherwise, we'll have this mentoring session again next week. We're not getting rid of the group mentoring sessions, guys. It's still happening. But I'm just including the one-on-one mentorships now for certain members who have access to the K2 indicators and K2 strategies. So yeah, no problem, Fraser. Other than that, guys, that's it. So let's wrap this session up. If you guys have questions, feel free to reach out. Otherwise, I will be back here tomorrow morning for the next live session as we continue on with this trading week.